Here is the bet the market is making on CoreWeave, ticker CRWV. In plain terms, it is a landlord for artificial intelligence computing. It borrows money, buys tens of thousands of Nvidia chips, and rents them to the largest AI labs on long contracts. It went public in March of 2025 at $40 a share, ran past 170, and now trades near 97. Behind that price sits a striking number, a signed revenue backlog of almost $100 billion. Strip away the noise, and the price is making one quiet assumption: that this rented, borrowed compute keeps compounding, that the contracts get paid, and that the chips hold their value long enough to clear the debt. That is the bet. The question tonight is whether it's a buy here or a trap. Start with the bull case, because the growth is genuinely staggering. Revenue in the first quarter of 2026 was about $2 billion, up 112% from a year earlier. Step back further, and the climb is even sharper. Revenue went from $1.9 billion in 2024 to $5.1 billion in 2025. And this is not a hope. Most of it is already contracted. The signed backlog is near $100 billion, with a single deal from OpenAI worth roughly $22 billion. Nvidia itself owns about 11.5% of the company and has agreed to backstop more than $6 billion of capacity. 21 of the 35 analysts who cover it rated a buy. One firm, Rosenblatt, calls CoreWeave the de facto operating system for AI. The demand here is real, and it is booked years out. Now the other side, and it is just as real. To buy all those chips, CoreWeave borrowed heavily. It carried about $25 billion of debt at the end of the first quarter of 2026. That debt is expensive. Interest alone cost $536 million in a single quarter, and the company still lost $740 million over the same 3 months. Then there is the concentration problem. One customer, Microsoft, accounted for 67% of all revenue in 2025. So 2/3 of the business depends on a single client deciding to keep buying. A short seller, Harrisdale, put it bluntly, calling CoreWeave a debt-fueled GPU rental business with no moat. You don't have to agree with the verdict to see the fragility. Heavy borrowing, real losses, and most of the revenue resting on one name. So what actually decides it? Here is the mechanism that ties both sides together, and it is a race against time. CoreWeave borrows money, buys Nvidia chips, and rents them out. So the model only works if the rent-to-collects arise faster than the debt comes due, and if the chips stay valuable long enough to be re-rented. But there is a catch built into the hardware. Each new Nvidia generation, Blackwell arriving after Hopper, can cut what the older chips rent for, and that decline can happen faster than the company writes those chips down over their roughly 6-year accounting life. The contracts are long and the cash is promised, but the asset underneath is melting. The deciding question is not whether the demand is real. It is whether the contracted cash arrives before the chips lose their value and the debt has to be paid. What would actually break the bull thesis? The kill switch to watch. 3 tripwires. First, the one customer. Microsoft is 67% of revenue, so if it renegotiates, slows down, or builds its own capacity, 2/3 of the top line is suddenly in question. Second, the chips. If rental prices for older Nvidia hardware fall as Blackwell floods in, the very chips that secure the debt are worth less, which can squeeze the loans against them. Third, the financing itself. Interest already runs over $500 million a quarter, so if cash from operations cannot keep pace, the debt becomes the story. None of these is breaking today. The backlog is signed and the growth is real, but each is a tripwire. And on a stock that swings far harder than the market, a turn can give the move back fast. Watch the Microsoft share. Watch GPU rental prices. So where does the thesis check land? Not a buy, not a sell. Those aren't ours to call, and we don't know your situation. The honest verdict on the thesis itself is stretched. Here is what that means. The growth is real, and unusually, it is contracted. A backlog near $100 billion, triple-digit revenue gains, and Nvidia's own money behind it. That part is intact. But the price rides on almost $25 billion of debt, 2/3 of revenue from one customer, and chips that lose value faster than the books admit. A signed backlog is not the same thing as durable free cash flow. The backlog is booked. The debt is too. Back to where we started. CoreWeave, the borrowed and rented engine at the center of the AI compute boom. Priced as if the contract's always clear. Now you have the thesis check to read it with. Triple-digit growth, a backlog near $100 billion, and Nvidia's backing on one side, almost $25 billion of debt, 67% of revenue from one customer, and fast-aging chips on the other. The verdict was stretched, not broken. A real contracted boom whose biggest risk is the borrowing and the single customer underneath it. None of this is financial advice or a recommendation to buy or sell. The figures come from public filings, so verify them yourself before any story decides for you. Growth can be rented. Debt has to be paid.